Welcome to the deep dive. Today, we're plunging, right into a topic that touches nearly every working American, your retirement saving.
Yeah, it's huge. Your retirement savings,
Yeah,
something most people think about or maybe try not to think about sometimes.
exactly. And we're asking a big question, something that honestly, just a few years ago would have sounded almost like science fiction.
Right.
Is Bitcoin about to become a commonplace asset within your 401k?
It's a fascinating question and timely.
It really is. Now, for most of us, retirement feels like maybe a distant horizon, or perhaps it's, rapidly approaching. But either way, it represents a monumental financial undertaking.
Absolutely. It's probably the biggest financial goal for most people over their lifetime.
And here's a fact that truly anchors the scale of this discussion. American 401ks alone,
Hmm.
they add up to a staggering $10 trillion.
It's
dollars.
almost an incomprehensible sum, isn't it? $10 trillion.
It really is.
To really try and grasp the magnitude of that, think about this. That's roughly equivalent to about 10% of all publicly listed stocks and bonds in the entire U.S. economy.
Wow, 10%.
Yeah. And for a different perspective, it's almost twice what the federal government spends in an entire year.
Okay, that puts it into perspective. Twice the annual federal spending.
Exactly. So this isn't just, a large amount of money. It's this vast, powerful pool of capital. It's constantly growing, and its sheer size, well, it naturally draws immense attention from basically every corner of the financial world.
That's precisely why this deep dive is so timely and, frankly, so pressing right now. We've recently seen what feels like a seismic shift, a specific executive order that seems poised to fundamentally alter how millions of Americans approach their retirement planning. It could potentially bring these so-called alternative assets right into the mainstream of long-term savings.
It really could.
So, our mission today is to unpack President Trump's recent executive order concerning these alternative assets in 401k. We're going to explore exactly what this means for individual savers like you listening.
And we'll delve into how these new asset classes, particularly Bitcoin, have actually performed. Because
Yeah,
performance matters, right?
absolutely.
Yeah.
And we need to consider the broader implications. What does this mean for the very future of retirement planning here in the U.S.?
And we're doing this by pulling insights from some really critical analyses and reports on this whole development. We're aiming to give you, the listener, a shortcut to understanding all the nuances without getting bogged down in, dense financial papers or jargon.
Right, we want to make it accessible.
What's truly fascinating here, I think, is that we're talking about a fundamental shift in how retirement capital, which, again, is one of the most significant and long-term pools of money in the world, is being approached and managed.
Yeah.
This isn't just about adding like a new button to your investment portal on your 401k website.
Whoa.
It's really about a reevaluation of what constitutes a stable and, importantly, a growth-oriented asset for that decades-long journey of retirement saving.
So let's unpack this allure of retirement money a bit more because, as you said, it really is immense. When we talk about that $10 trillion figure for 401k, it's not just a statistic sitting on a page.
No, not at all.
This capital is a dynamic, active force within the national economy. It's constantly being invested, moved around, managed. It's just an enormous, tempting target for virtually every financial institution out there.
Indeed. And what makes this particular pool of capital so appealing, maybe even more than just its sheer size, is its largely passive and crucially long-term nature.
Passive and long-term.
Yeah. For asset managers, for financial advisors, even, the consultants who facilitate big industry mergers and acquisitions, getting access to what they often just call pension money, which here definitely includes 401k, is incredibly desirable. As one of our sources colorfully put it, it's often described as a wet dream for them.
Right, I saw that phrasing. Tells you something.
It does. And the reason is pretty simple. It's generally stable, long-term capital. Think about it. Individuals like you contribute to their 401ks consistently, paycheck after paycheck, often for decades.
Yeah, set it and forget it for many.
Exactly. This money isn't typically subject to the volatile, short-term, speculative movements you might see in other parts of the market. It's more of a steady, predictable stream of funds that could be invested for the long haul.
Which is gold for asset managers.
It's an extremely attractive proposition for those looking to manage assets and, let's be honest, generate fees over extended periods. It provides this really reliable base upon which they can build their business models.
And it's only getting bigger, right? This isn't a static pool of money.
Not at all. This phenomenal growth in 401k assets connects directly to these broader trends we're seeing in the U.S. You've got aging populations.
Right. Baby boomers retiring.
Exactly. And coupled with that, a much heavier emphasis on individual saving for retirement. Think about traditional pensions, those defined benefit plans that guaranteed a specific income.
They're mostly gone, in the private sector anyway.
Far less common, certainly. The responsibility, the burden, really, for retirement security has increasingly shifted from employers onto individuals, primarily through accounts like the 401k,
Yes, on us now.
which creates an even larger and more appealing target for financial industries looking to manage these ever-growing pools of capital. It's this powerful, self-reinforcing cycle, constantly expanding the target for these firms.
And it really underscores why new avenues for growth within this massive space are so keenly sought after by everyone in finance.
Absolutely. And this immense capital pool, this growing pressure on individuals to secure their own future, it's now been directly addressed by a truly significant policy shift.
Okay, let's get to the core of it, the executive order.
Yeah, we're talking about what could be a game-changing executive order. On August 7th, 2025, President Donald Trump issued an executive order that explicitly aims to, and I'm quoting here, allow private equity, real estate, cryptocurrency, and other alternative assets in 401k.
Explicitly. Private equity, real estate, crypto, that's a big shift.
It's a monumental pivot from the traditionally, let's say, conservative investment options typically available within these tax-deferred plans. It's not just a suggestion, it's a direct instruction to open the door for these new asset classes.
That's the core event we really need to focus on, and the impact of this order.
Potentially massive.
Potentially huge. It's designed to make it significantly easier for approximately 80 million Americans. I mean, just think about the scale of that number, 80 million people.
Yeah, that's a huge chunk of the workforce.
To hold what are currently considered non-standard assets within their tax-deferred retirement plans. For so long, 401ks have been, pretty limited to a relatively narrow band of traditional investments.
Mutual funds, ETFs, maybe some bonds, pretty much. This executive order is essentially throwing open the doors, creating a pathway for potentially unprecedented access to asset classes that were previously mostly reserved for, say, institutional investors or very high net worth individuals.
So it's kind of democratizing access, in a way.
That's one way to frame it, yeah. It could reshape millions of retirement portfolios if people choose to use these new options.
To really grasp the scope of this change, maybe it's helpful just to quickly clarify what a 401k actually is for anyone who might be less familiar.
Good idea. So in essence, it's a mechanism where a portion of the employee's wages is diverted, often before taxes, into a specific investment account.
And often your employer matches some of that contribution.
Right. The employer match is a huge incentive. And within this account, you, the employee, typically have choices about what assets are held and in what allocation. But historically,
Limited choices.
very limited choices usually, primarily consisting of mutual funds, which are basically collections of stocks or bonds, or maybe broad stock market exchange-traded funds, those ETFs you mentioned, or perhaps some high-yield bond portfolios.
And the thinking behind that limitation was always.
Well, the underlying principle has always been about offering diversified, relatively stable options for long-term growth, with a strong emphasis on risk management. Fiduciary duty is key here.
Okay. And a huge part of why these accounts are so popular, so significant, is their tax efficiency, right?
Absolutely critical. You save money on a pre-tax basis. That means the money goes into the account before it's taxed by the government.
Which lowers your taxable income now.
Exactly. And then it grows tax-deferred. You only pay taxes when you eventually withdraw it in retirement, and the theory is you might be in a lower tax bracket then.
Hopefully.
Hopefully. Plus, as you said, employers often get tax incentives for matching contributions, which makes it a genuine win-win. It encourages saving, provides immediate benefits to both sides.
Yeah, that unique structure is really why 401ks have become the bedrock of American retirement savings for so many people.
For sure. And this brings us back to the regulatory landscape that governs these accounts and, what the current access actually looks like for something like Bitcoin.
Right, because the order doesn't just say do it, it tasks an agency.
Precisely. The executive order specifically tasks the Department of Labor, the DAO, with updating its guidance and establishing minimum standards for what constitutes appropriate investment access in these retirement accounts.
Okay, the Department of Labor.
This isn't just a suggestion. It's a direct mandate for a federal agency to act. And the DOL is the primary federal agency responsible for administering and enforcing ERISA, the big law governing retirement plans,
ERISA.
which gives this executive order significant weight and a clear path for implementation. They have to issue new rules or guidance.
And it's crucial to understand this isn't just like a free-for-all, right? The Wild West.
No, definitely not. The guidance from the DOL must be, and the order says this, subject to the Employee Retirement Income Security Act of 1974, or ERISA, as we mentioned.
And ERISA is.
That's a foundational piece of legislation. ERISA sets minimum standards for most voluntarily established. Its whole purpose is to provide protection for individuals in these plans.
So safeguarding the savers.
Exactly. It's designed to safeguard plan participants and their beneficiaries. So these changes aren't happening in a regulatory vacuum. They're occurring within this well-established, legally defined framework that prioritizes the security and prudent management of retirement funds.
Prudent management. That sounds key.
It is. It means the DOL's new guidance will have to somehow balance the potential for higher returns from these alternative assets with ERISA's inherent focus on fiduciary duty and managing risk appropriately. It's definitely a tightrope walk for them.
Yeah, balancing higher potential returns with higher potential risk, presumably.
That's the core challenge. And this context is really vital for appreciating the magnitude of this potential shift.
Yeah.
According to Tefra Digital, which is an investment firm focused specifically on digital assets,
Okay.
they report that currently only a handful, like literally just a few, U.S. asset managers currently allow unrestricted access to Bitcoin ETFs in the plans they manage.
Only a handful. Out of everyone managing 401k.
That's what they report, which highlights just how limited access to cryptocurrencies has been within traditional retirement plans up until now.
Wow. Okay.
It underscores just how significant President Trump's executive order is in potentially expanding that access from what is currently a very niche offering to something that could become a widespread possibility for millions of Americans.
It essentially moves Bitcoin from being this obscure, hard-to-get asset for the average 401k participant
Right.
to something that could potentially become a standard option on the menu, just like a, large cap growth fund or a bond portfolio.
That's the potential transformation, yes.
So with this new regulatory landscape potentially emerging, why is everyone suddenly, or perhaps not so suddenly, so keen on these alternative assets, especially Bitcoin?
Well, let's look at the track record, because ultimately performance is what commands attention in investing.
True.
And here's the key insight our sources highlight. Bitcoin, along with other alternatives like real estate, and that includes REITs, those real estate investment trusts.
Right. Companies owning income-producing property.
Exactly. And private equity. These are all asset classes that historically have consistently outperformed the S&P 500 index.
Consistently outperform the main benchmark for U.S. stocks.
Yes. And we're often not just talking about minor outperformance. We're talking about significant, sometimes compelling returns that make these assets look incredibly attractive to long-term investors.
Especially if you have that decades-long horizon of retirement planning.
Precisely. Take private equity, for instance. For listeners maybe less familiar, private equity generally involves investing in companies that aren't publicly traded on a stock exchange.
Okay.
These investments are often made by specialized private equity firms, raising funds from big institutional investors like pension funds or university endowments.
Right, the big players.
And this asset class has a pretty well-documented track record. It usually posts, say, a couple of percentage points of excess returns compared to public markets over the long run.
A couple of points might not sound like much, but over decades.
It makes an enormous difference due to compounding. That consistent outperformance is exactly why sophisticated pension fund managers, who are responsible for managing these massive pools of capital for retirees, are very keen to include private equity in their client portfolios.
Right, because those extra points are crucial for hitting retirement goals.
They really are. They can significantly boost overall portfolio growth and ultimately contribute to the financial security of retirees.
But then you look at Bitcoin's staggering returns, and it seems to stand out even more, maybe in a league of its own.
It really does. Fidelity, for instance, a major, very traditional player in the financial world, they actually began experimenting with allowing Bitcoin in 401ks over 3 years ago.
That feels like ages ago in crypto time. 3 years.
It does. And that was a very early, very public signal in the personal finance world that something significant might be shifting. You had a major traditional institution recognizing the potential, however nascent, of this new asset.
And the results since that experiment began.
The numbers are, frankly, astonishing. Since that experiment began, Bitcoin has returned an incredible 215%.
215% in about 3 years.
Let that sink in for a moment. Over 200% return.
Okay, need context, though. How did traditional investments do?
Great question. To put that in stark contrast, over that very same period, the S&P 500, remember, the benchmark for large U.S. stocks, where most traditional 401k money has historically flowed, it returned approximately 54%.
54%, which is a solid return. Normally, you'd be happy with that over 3 years.
Absolutely. A good return in its own right. But it just pales in comparison to Bitcoin's 215%.
Okay.
And it gets even more compelling, I think. Even the so-called Magnificent Seven stocks, the Apples, Amazons, Googles, Nvidias of the world.
The tech giants driving the market lately?
Exactly. The ones that have constituted the bulk of the positive returns in the S&P 500 recently, they were only up about 150% in that same time frame.
Only 150%. Still amazing, but less than Bitcoin.
Still amazing, yes, but significantly less than Bitcoin's 215%. So Bitcoin didn't just outperform the broad market. It dramatically outperformed the very best, highest performing traditional stocks during that specific period.
That really illustrates not just strong performance, but a truly unique and powerful growth trajectory, at least over that time frame.
It certainly does.
That's an incredible comparison. It really hammers home the outperformance. And our source makes an even bolder claim, stating that, let me find it, over almost any time period, Bitcoin is the best performing asset in the world.
That's a huge claim.
It is. Any time period. What drives that kind of consistent, or at least historically consistent, long-term outperformance that leads someone to say that?
Well, it's likely a combination of factors, and people debate these constantly, of course. But at its core, you have Bitcoin as this digital, decentralized, and provably finite asset.
The scarcity argument, the 21 million coin limit.
Exactly. Its scarcity, with that fixed supply cap, creates a potentially powerful demand dynamic, especially as its adoption grows globally among individuals, institutions, even nation-states now. It's often viewed as, as digital gold, a potential store of value that's maybe resistant to traditional monetary policy or inflation, operating outside government control.
Right.
As more entities begin to recognize and integrate it, that network effect potentially strengthens its value proposition further. The system becomes more valuable as more people use it.
And the longer the time horizon.
The longer the comparison period, often the more favorably Bitcoin ranks. Precisely because these fundamental drivers, if you believe in them, have more time to play out and accumulate.
Okay.
So for assets that need to grow over 20, 30, maybe even 40 years, like in retirement accounts, this potential for long-term outperformance is exactly what financial planners and individual savers are often looking for.
Especially if traditional returns seem lower going forward.
Right. Especially in an era of perhaps uncertain returns from traditional bonds or even stocks. Thus, the argument goes, holding it in the longest-term pools of capital, like retirement accounts, could be considered both efficient and beneficial. It's about maximizing potential growth for a secure financial future, acknowledging the risks, of course.
Efficient and beneficial. Strong words.
Yeah.
So it's clear that Bitcoin's performance is compelling enough to attract serious attention. But as you alluded to, it's not just about individual savers suddenly getting direct access through this potential executive order guidance.
No, not at all.
This trend seems to be already happening at a much larger scale, way beyond just individual 401k plans. We're seeing a pretty significant institutional and corporate embrace of Bitcoin that actually predates this executive order.
Absolutely.
Yeah.
Which suggests this might be more of a natural market evolution rather than just a sudden politically motivated shift.
Okay, like what?
Well, for example, some of the most prestigious university endowments have been leading the way for years.
University endowments, like
See?
Harvard, Yale?
Yes, exactly. Universities like Brown University, Emory University, Harvard University, and even the University of Austin. These are institutions renowned for their highly sophisticated investment strategies and extremely long-term horizons for their endowments.
They manage billions, right? And think in terms of decades, even centuries.
Precisely. They actually added Bitcoin to their portfolios years ago. We're talking 2019, 2020 for some.
Years ago, wow.
These are institutions known for rigorous due diligence and a multi-decade outlook, not typically involved in short-term speculation. They apparently recognized its potential as maybe a diversifier or a growth asset far ahead of the curve.
So the smart money was already getting in.
That's one interpretation, yes. And it's not just direct investments. Other prominent universities, including the University of Pennsylvania and the University of California, Berkeley, have received very large Bitcoin donations, further integrating it into their financial ecosystems.
Okay, so donations too.
This consistent pattern shows that highly sophisticated institutional investors, managing billions in capital with very long timelines, have already recognized and acted on Bitcoin's potential value as perhaps a legitimate asset class.
And it's rapidly moving into the corporate world too, right? With major corporations integrating Bitcoin directly into their holdings, even companies in the S&P 500.
That's another key development. Think about Tesla, the electric vehicle and clean energy giant.
Sure, everyone knows Tesla.
It's been part of the S&P 500 index for years now, a major component, and it's held Bitcoin on its balance sheet since early 2021.
Right, I remember when they announced that. Big news.
Huge news at the time. This isn't some niche private company. It's a major publicly traded S&P 500 component that made a strategic decision to allocate a portion of its corporate treasury, its cash reserves, to Bitcoin. It was groundbreaking, signaling corporate confidence in the asset.
Okay, who else?
And then you have companies like Coinbase, the prominent cryptocurrency exchange.
Yeah, the main place many people buy crypto.
They actually joined the S&P 500 index in May of this year, 2025, which was a huge milestone for the crypto industry itself, representing its formal entry into the traditional financial mainstream via a major index.
A crypto exchange in the S&P 500.
Yeah. And what's more, Coinbase has explicitly committed to building a larger Bitcoin stack, holding more Bitcoin as part of its corporate strategy. So it's not just participating, it's doubling down on Bitcoin itself.
Interesting. So it's a direct crypto-native company entering this traditional index and planning to hold more Bitcoin.
Exactly. Signaling a long-term commitment.
Right. And Block, that's another one, right? The company behind Square and Cash App.
Yes, Block. A payment processing giant that many listeners might use every day. They're already the 12th largest corporate holder of Bitcoin, according to public data.
12th largest.
Yeah, and they joined the S&P 500 just last month in July 2025.
So more recent.
More recent, yes.
Yes.
So you're seeing these financial technology behemoths, companies right at the forefront of digital payments, not just acknowledging Bitcoin, but actively integrating it into their corporate treasuries and joining the ranks of the most prominent U.S. public companies. It shows a growing mainstream acceptance.
Tesla, Coinbase, Block, all in the S&P 500 now, all holding Bitcoin.
But perhaps the most interesting case in this whole corporate integration story, and one that has really profound implications for retirement money, is MicroStrategy.
Ah, MicroStrategy.
Michael Saylor's company.
Exactly. Led by Michael Saylor, MicroStrategy is by far the largest corporate holder of Bitcoin, just massive holding.
Yeah, their numbers are huge. And it's considered quite likely that they will join the S&P 500 index in the very near future, based on standard index inclusion criteria like market cap and profitability.
Okay, so potentially another Bitcoin-heavy company entering the index.
Yes, but this company's explicit business model is unique and particularly relevant to our discussion today about retirement funds.
Okay, here's where it gets really interesting and maybe a bit surprising for some listeners who haven't followed this closely.
Go on.
MicroStrategy's explicit business model, particularly in recent years, seems to be, as our source puts it, to hoover up funds from the traditional financial market to buy more Bitcoin.
That's a fair summary. Think about that for a second. They're raising money through very traditional means, issuing corporate debt, selling convertible notes, selling more shares of their own stock to institutional investors, leveraging their balance sheet.
Using all the standard Wall Street tools.
Exactly, and then using that capital primarily to acquire more and more Bitcoin. They've essentially transformed themselves from a business intelligence software company, which is what they started as.
Right, they still have that business.
They do, but strategically they've pivoted to become almost like a publicly traded vehicle, an accessible wrapper for Bitcoin exposure.
So you could invest in MicroStrategy stock, MSTR, and effectively you're investing in a company whose primary strategic asset and treasury reserve is Bitcoin.
That's the core idea. And this leads to a critical insight about what our sources call the passive flow argument.
Passive flow. Okay, what's that?
It has significant implications for retirement funds. What this means is that even if you, as an individual saver, don't directly choose to invest in Bitcoin in your 401k, maybe your employer hasn't enabled it yet, or maybe you're just not comfortable with direct crypto exposure.
Which many people might not be.
Understandably. Even so, any passive flow from broad retirement funds, like index funds, will still ultimately end up allocating some money to Bitcoin, but via the wrapper of the company's shares.
Okay, break that down. How does that work?
So, to clarify, if your 401k invests in a broad S&P 500 index fund, which is a very common, often default option,
Right, millions are invested that way.
and companies like Tesla, Coinbase, Block, or eventually MicroStrategy are components of that S&P 500 index. Then a portion of your retirement money, your 401k contribution, invested in that index fund, is indirectly finding its way into Bitcoin holdings.
Because the index fund has to buy shares of those companies to track the index.
Precisely. The fund buys shares of, say, MicroStrategy because it's in the index, and MicroStrategy's value is heavily tied to its Bitcoin holdings.
So your retirement money owns a tiny slice of MicroStrategy, which owns a lot of Bitcoin.
Exactly. It's a subtle but potentially powerful pathway for retirement capital into the digital asset space. It makes the integration of Bitcoin into traditional finance seem almost inevitable, regardless of individual direct investment choices within the 401k.
Wow, so the executive order might just be formalizing something that's already happening indirectly.
That's one way to look at it. The passive flows are already starting to occur through these corporate wrappers, #, skepticism, criticisms, and the evolving financial landscape.
So that passive flow argument is truly eye-opening. It demonstrates that Bitcoin's reach into traditional finance is maybe broader and more embedded than many realize.
I think that's fair to say.
But now we absolutely have to address the elephant in the room, the skepticism. And it's reasonable skepticism, right? Especially when we talk about President Trump and cryptocurrency. There are valid concerns that need to be discussed.
Yes, and it's important here, as we always try to do, to remain impartial and simply report what the source material highlights regarding criticisms and potential conflicts of interest without taking a side ourselves.
Agreed. So what does the source say?
The source explicitly mentions concerns in light of his self-enriching schemes. That's the phrasing used. He gives specific examples,
Okay.
such as the Trump and Melania meme coins, which, just for clarity, are a type of cryptocurrency often based on internet memes or cultural references, usually created for speculative or humorous purposes, not fundamental value.
Right, the really speculative end of crypto.
Yes. And the source notes these were conveniently launched days before his inauguration. It also points to the Trump family's involvement in something called World Liberty Financial.
Okay.
These examples, as presented in the source material we reviewed, do raise valid concerns about conflicts of interest and the potential for him, and perhaps his family, to profit from presidential influence or policy changes with potentially minimal regulatory oversight.
So people are questioning the motives behind this executive order, wondering if it benefits the decision maker personally.
That's the core of the criticism, yes. These are significant points of contention for critics who question the motivations behind policy shifts like this one regarding crypto and 401ks.
But despite those criticisms and concerns, the source also presents a fascinating counterargument. It says that the executive order is still a clever proposal.
Yes, it does present that view as well.
And that's interesting because it directly connects to a very real and frankly stark reality many Americans are facing: uncertain retirement prospects.
Yeah, that's undeniable for many.
Let's be honest, the idea that public programs like Social Security alone will be sufficient to maintain your lifestyle in old age, that's becoming increasingly unlikely for many people, right?
It's a widespread concern. We're seeing strains on Social Security, rising healthcare costs are a huge factor, and there's just this general sense of unease about whether future generations will be able to enjoy the same quality of life in retirement as their parents or grandparents did.
It feels like the ground rules have changed.
Exactly. And the problem, as the source points out, is that for many Americans, their actual meager savings, both inside and outside their formal retirement accounts, are often simply too small to support their accustomed lifestyles once they stop working.
The retirement savings gap.
It's a significant societal challenge. You can trace it to decades of stagnant wages for many, rising costs of living, insufficient personal savings rates, lots of factors.
So in that context,
In that context, the proposed solution seemingly offered by the executive order is that holding assets with higher returns is one way out of this conundrum.
okay, so framing it as a potential solution to a real problem.
Right. It frames the executive order not just as a political move or potentially self-serving, but as a potential, though certainly debated and risky solution to this deeply rooted financial problem for millions of people.
It's trying to provide a pathway to potentially greater wealth accumulation in a landscape where traditional investment returns might not be enough anymore to guarantee a comfortable retirement.
That seems to be the argument for it, yes. Giving people more tools, more options, even if they carry higher risk.
But then you have the critics' perspective, and it's a strong one. For them, this whole idea smells like yet more insider dealing, coupled with suspicious offloading of risks to ordinary Americans who are just trying to save for retirement.
That really highlights the core tension here, doesn't it?
It does. Let's break that down. Insider dealing. What might that look like in this context?
For critics, insider dealing could manifest as influential individuals or groups perhaps benefiting disproportionately from new regulations that they might have helped shape. Or maybe having advanced knowledge of policy changes that allow them to make advantageous investments before the public.
Okay. And the offloading of risks.
That part refers to the concern that potentially volatile, less understood assets like cryptocurrency, with their really significant price swings and complexity.
Things that can go up 200% can also go down a lot.
Exactly. That these might be pushed on to average savers who perhaps lack the sophisticated financial knowledge or the genuine risk tolerance to manage them effectively within a retirement portfolio.
Potentially jeopardizing their retirement nest egg if things go wrong.
That's the fear.
Yeah.
That's the big question really at the heart of the debate. Is this genuinely about empowering average Americans with more choices? Or is it a mechanism that primarily benefits specific interests while shifting significant risk onto the shoulders of individual savers?
A really crucial question.
It is. But regardless of where you personally stand on that debate, the source leaves us with a pretty powerful concluding statement on this section, saying, but, like it or not, retirement money is passively finding its way into Bitcoin anyway.
Right. Back to that passive flow argument.
Exactly. It reinforces the broader message that whether you personally like Bitcoin or not, whether you think it's the future or a fad, and even if you think Trump's dealings seem self-serving and catering to special interests, the reality is Bitcoin is part of America's financial present and future. It's not some fringe asset hiding in the corners anymore.
It's increasingly woven into the fabric.
It seems to be, yes.
Yeah.
Woven into the fabric of the global financial system, from those sophisticated university endowments we talked about to major S&P 500 corporations. Its integration in various forms appears to be an ongoing, perhaps unstoppable trend.
So it's happening either way, one way or another, directly or indirectly.
That seems to be the underlying point. And the ultimate impact of this executive order, then, as the source puts it, is that making it easier to hold in retirement accounts just strips out the middleman.
Strips out the middleman, meaning?
It implies a streamlining of this seemingly inevitable trend. Instead of relying only on indirect exposure through, say, buying MicroStrategy stock,
Right.
it allows potentially direct access within the 401k itself.
Mm-hmm.
It cuts out a layer of complexity and perhaps cost for those individuals who do recognize its potential and do want direct exposure as part of their long-term strategy.
It makes it more efficient for the market and for individuals to move towards a future that seems likely to include digital assets in retirement planning, for better or worse.
It simplifies the process, yes, for those who want to incorporate it directly. This is a significant development because it really could democratize access to an asset class that, as we discussed, has historically been quite difficult for the average 401k participant to acquire directly within that tax-advantaged structure.
Yeah.
It's about bringing a high-performing, albeit admittedly volatile asset potentially within reach of millions, allowing them the option to capture some of that potential growth in their long-term retirement planning, if they choose to take on the associated risk. Hashtag tag outro.
Wow, okay. What a deep dive that was into a truly transformative potential shift in retirement planning in the U.S. Let's try and quickly recap the key takeaways here.
Yeah, lots to digest.
We started by looking at the immense scale of American retirement savings, that staggering $10 trillion just in 401ks alone.
Right, and how that vast, mostly passive pool of capital is incredibly attractive to various financial industries. The wet dream phenomenon.
Exactly. Then we dove into the specifics of President Trump's executive order from August 7th, 2025, which explicitly aims to open the door for alternative assets, private equity, real estate, and crucially, cryptocurrency into these accounts for potentially 80 million Americans.
And we clarified how 401ks work, their tax advantages, and the current, very limited regulatory landscape where only a tiny handful of asset managers currently offer unrestricted Bitcoin ETF access, which really underscores the magnitude of this potential change.
And then we really dug into Bitcoin's striking performance. We saw how over certain periods, like the one since Fidelity's early experiment, it hasn't just outperformed the S&P 500.
Which returned about 54%.
But even the high-flying Magnificent Seven stocks, Bitcoin saw an incredible 215% return in that time frame.
Yeah, the numbers are eye-popping. And the claim that it's been the world's best performing asset over almost any time period, making it incredibly appealing on paper for long-term capital like retirement funds, despite, and we have to stress this, its well-known volatility.
Absolutely. Volatility is key. We also discuss how this isn't just a bottom-up individual investor story waiting for access. There's significant top-down institutional and corporate embrace already happening.
Right. Sophisticated university endowments like Harvard and others adding Bitcoin to their portfolios years ago.
And major S&P 500 corporations, Tesla, Coinbase, Block, already integrating Bitcoin into their holdings, making it part of the mainstream index landscape.
And that unique strategy of MicroStrategy, acting almost as a Bitcoin holding company, powerfully illustrates how retirement money can even passively flow into Bitcoin through company shares and index funds, whether individuals opt for direct exposure in their 401k or not.
That passive flow point is really crucial. Finally, we address the skepticism and criticism surrounding the executive order, particularly concerns about potential conflicts of interest given past dealings,
Which the source highlighted.
while also presenting the counterargument that it could be seen as a clever proposal to help Americans facing uncertain retirement prospects by giving them access to potentially higher return assets.
And ultimately, the message seems to be, whether you're a fan of Bitcoin or not, whether you believe this executive order is well-intended or self-serving, Bitcoin appears to be an undeniable part of America's financial present and future.
And this order, if the guidance follows through, merely streamlines an inevitable trend, stripping out the middleman for direct access.
That sums it up well. So, what does this all mean for you, the listener, tuning in today?
Yeah, why should you care about all this?
Well, understanding these developments isn't just for financial professionals or market watchers anymore. It's becoming crucial for navigating your own financial future and making informed decisions in what is clearly a rapidly evolving economic landscape.
The options available to you for retirement saving, the risks you might face, and the potential rewards you might seek, they're all shifting.
Exactly. Making knowledge about these new asset classes, their potential and their pitfalls, more essential than ever for your own long-term financial security planning.
And as we wrap up this deep dive, here's maybe a final thought to ponder as you go about your day. As digital assets like Bitcoin increasingly intersect with traditional finance, becoming integrated into something as fundamental as our retirement savings, what are the long-term societal and individual impacts we might anticipate?
That's a big question. How might this transformation redefine what it truly means to be secure in retirement? Does it mean taking on more risk for potentially higher reward?
And what new opportunities or perhaps new challenges might emerge for the average American saver who has to plan for decades into an increasingly digital and maybe more volatile financial future?
It's a question that will undoubtedly unfold over the coming years, maybe even decades.
And it's one we'll certainly be keeping a close eye on right here on The Deep Dive. Thanks for joining us.